Hey, welcome back to the Stock Market Starters YouTube channel. Today is our last day talking about investment analysis for the time being and looking at these 6 companies that we have been analyzing the last couple of weeks. So I'm really excited. We're going to jump in. We're going to talk about what each of these 6 companies are. We're going to talk about the investment analysis we've done, and then we're going to do a comparative analysis and really make a plan to say, hey, what do you do after you've done your initial investment analysis, right? What comes next? So let me show you guys what I'm looking at and we will hop on in. So of course, this last couple weeks, we've been looking at and investing in a couple companies. I've bought just one share as an example. Now, a lot of these were at bad buy points and whatever. That's okay. It's just pretty much an example at this point. But I want to show you guys what this looks like. So first one we bought into was Ford. We bought in back here for $10.81. Obviously, it's going down now. Not a huge deal. And we're going to see that with a bunch of these, right? The S&P has been dropping here the last couple weeks. And so a lot of these investments have as well. But of course, these are longer term investments, right? This is not looking to get in for a day or a week, right? This is looking to get in for months or years at a time and see if we can get some continued appreciation over time. So the first one we got into was Ford, right? Ford Motor Company. Next, KHC, Kraft Heinz Company. Also moving down, though, in a bit of an uptrend. It looks like it might be breaking. To be fair, though, right? If we want to look at this, we could also probably do a bit of a trend line there. Or let's actually fix that because that's kind of terrible. Let's do it something more like this, right? I mean, we can easily draw a trend line here that still makes sense, matches with the 50-day. Really, until we get below that 50-day, I think there's nothing to be, concerned about in terms of a bigger drop. If it does go down, right, we could see a drop down to here. That would not be the end of the world, nor entirely shocking. Though we'll see, right? We were talking about this morning on the daily stock talk program. But, it's like, hey, this is cool because, again, looking for that continued appreciation, looking for that dividend. So KHC, Kraft Heinz Company, is our second one. Third, we've got Verizon, right? Verizon Wireless, Verizon Communications. This one actually moving up really, really strongly the last couple of days, even with the overall market dropping. So that's cool to see. Coming down a little bit today, but nothing terribly concerning. This one to me looks like it's been consolidating. And I think, if we get some more movement to the upside or to the downside down below, really this horizontal area around, 39, maybe 38.50, right? I think if we were to drop below there, I think there's some room to the downside. I think moving up where we're at now, there's some room to the upside for that kind of longer term look. Looking at a weekly chart when we, pop in and say, hey, look at how much room there is on either side of where we've been. And we've been consolidating here really all year, right? Since January, we've been kind of consolidating in this area right in here. So very interesting to see that one. Next, we've got GM, General Motors, of course, dropping very, very strongly today and this week. I'll pop this one over here back to a daily, I suppose. But, right, dropping today, dropping yesterday, but not the end of the world. This one, though, is interesting because I think this one has some room to drop, right? I would not be terribly surprised to see it down in here again, especially after making this double top that was pretty strong right here and after breaking out of the uptrend that it was in for quite some time, right? We can see it was really uptrending here, really since December, November, last year, November, December, right? Coming up really since then. Now coming down with some force, so this one could drop a little bit, could put us in a negative position in terms of this one share right off the bat, but not the end of the world. Again, this is kind of an example, and as we're looking at investments as a longer term perspective anyway. Next up, we're looking at Main Street Capital. This one, lots of dividend payments. They come in quite often, basically monthly. And this one I think has some, if it gets out of this box to the upside or the downside, I think there's some potential for bigger movement here. But right, Main Street Capital, this was a interesting one in our analysis for sure. And then last but not least, we've got Home Depot that has been uptrending, pulled back pretty strongly here earlier today, coming up a little bit. So we'll see, but really just cruising through this uptrend. And I think this one's in a pretty good spot trend wise. Of course, looking longer term, we'll see how long that trend holds. But this one has some room to the upside for sure. And in the last 3 years, it got all the way excuse me, all the way up to $420, and then all the way down to 264. So we'll see what happens with it. Of course, we can monitor and manage as is appropriate, as we'll do with all of them. So that's kind of the 6 companies we are looking at. Of course, we've done our analysis on them all, so I'm not going to go through each of these numbers and say what they all are, right? But we looked at market cap, EV, right? Enterprise value. We looked at beta, or how correlated we are to the market. We looked at the PE ratio, right? How much are you paying for earnings? And then PEG ratio, right? How much do we expect to pay for future earnings growth? And then we looked at, earnings per share. We looked at dividend yield. We looked at some of their financial numbers on their income, right? Their EBITDA, earnings before interest, taxes, depreciation, and amortization. And then we looked at revenue, and we charted out revenue trends for each of these companies. So we got Ford, KHC, Verizon, GM, Main, and Home Depot. And so we kind of, have our trends, have our graphs here. So what we're going to do is kind of talk through, all right, what do each of these look like? And then we'll do a trend of each of these revenues and see how they stack up against one another. So, overall, after kind of looking at these, going through them, I really like a couple of them for a couple of key reasons, and there's a few that I don't like as much. So, at a cursory glance, what do I look for, comparatively? I look for a couple things, but I really look at dividend yield, because I really like dividends, right? I really appreciate the dividends being able to be paid and then reinvested or invested elsewhere, right? I really, really like that. I think that's really fun, kind of rewarding. Now, there are some tax considerations, with dividends versus, if you're in like a Roth IRA type of account, or you have deferred taxes on your investments. Sometimes that'll change with dividends, and dividends are taxed differently than long-term capital appreciation. But, those are sort of deeper conversations, honestly, not super, super important. And the way that I kind of think about it, at least at a cursory glance, is, hey, taxes matter. Yes, I want to optimize my taxes, but I also want to have better investments. And I really, really like dividends because they're kind of a cool reminder. Hey, I'm getting paid to own this company. So pretty cool. So cursory glance, right? I really like the dividend yield on Ford. I like the dividend on Verizon, and I like the dividend on KHC. And I actually really like the Main Street, right? The Main dividend as well is really nice. But, right, I know a couple of these I don't like, right? Main, I took a note. I don't love where this is at overall. Why? I don't like the potential for negative growth expectations, right? I do not like that. I also don't like the substantially lower EBITDA. Now, is that the end of the world? Not really, right? I mean, this is still a big enough company. The other thing I don't love on this one really is, right, they have good earnings per share. They have good dividends, but they have smaller EBITDA and they have smaller earnings, right? I mean, if you just look at the size of these numbers, right, we're talking, I mean, these are all in thousands, but 50,000 versus 122 million, right? Versus 26 million versus, 127 million, 132 versus 50,000. So, right, smaller earnings, smaller EBITDA. Okay, well, that makes sense. But good dividend yield. I do not like that there's potential negative growth expectations. Now, that said, I could look past that and I could look into it deeper. But for the sake of, kind of our example, and we are doing a pretty high level investment analysis, right? We're not going super, super deep in each of these companies. Truth be told, I think there's probably, some things where really all I'm looking at here that I don't like is the negative growth expectations. Everything else to me makes sense, looks good. Overall, now there are some other considerations, but right, if we were to look into this and say, okay, are the negative growth expectations real? What does this actually look like? Let's dig into it deeper. That'd be a longer conversation. And I think, truth be told, this probably is fine in terms of investing. But the negative growth, don't love. And then, what's interesting is that, hey, there's negative growth, but like, look at that revenue trend, right? Their revenue is absolutely skyrocketing. So interesting to see. So I expect that Main is probably fine, but I know, hey, regardless, I'm not going to go dig into it super, super deep right now. So probably not super, super interested in starting and getting a huge position in Main. Okay, so good. There's one. Next, right, we've got KHC. Okay, this is cool, but I don't like their EPS or their EPS is actually fine. The earnings per share is not bad. Not terribly concerning at all. What I don't like is their PE ratio, right? Their PE ratio at 23.2. That's a high PE ratio, right? I don't love that. Same thing with Home Depot, high PE ratio. So okay, high dividend, but the high PE ratio makes me a little less inclined. Okay, so then we look at Verizon. Again, a little bit of a high PE ratio. What I don't like here as much is this PEG ratio, right? PEG ratio is over 1, which means I'm expected to pay, if I were to buy in now, over $1 for $1 of future growth earnings or earnings growth. So that to me is a little less appealing. Okay, so what does that leave? Hey, Ford, right? Okay, Ford, what are Ford's numbers, right? Earnings per share, under $1. I don't like that compared to everything else, right? The earnings per share are a lot lower. But there are some things that I do like. I really like that dividend yield. I like the PEG ratio, right? This is, besides for GM, our second highest PEG ratio, which I really like, right? So we're paying less for per dollar of future earnings growth. PE ratio, also not bad, right? This is a fairly low PE ratio. Now, GM, a little lower, Main, a little lower. So those are cool. But otherwise, I kind of like Ford. So, cursory glance, I'm liking Ford. Also, as we look at this, I also am kind of liking GM, which is interesting because those are both in the automotive industry. Now, GM's dividend, a lot less, right? It's basically a 1% dividend versus 5.5, 5.6% dividend. So, right, Ford's got a better dividend yield than GM, so I really like that. Which is, that's interesting. That's telling. Um, so, that's kind of what we're looking at. Other things that kind of, are key to pay attention to is this revenue trend. So I want to not look at EBITDA. Let's look at our revenues and let's just graph them all comparatively. Now, this will take a second, but what's cool is that this will show us actually a lot of good information, I expect. Oh, back. That's not what I wanted. There we go. Okay. So, no. Perfect. Okay, there we go. Chart title. That's what I need. So, we want our comparative revenue trends. Now, I am not entirely sure this actually did it the right way, but let's see. Yeah. Yeah, I graphed it the other way. So I want to. Yeah, that's not what I need. I need to graph it. So I'm showing. Oh, maybe I need to do this. Do that, and then do this, and then graph it. Let's see if that works, because that's kind of how I've been doing on the rest of these. Same deal. Okay. So let's do it with two of them. These, and then let's see if this will work. Uh-huh. Yep, that one worked. So let's see. I can include number 3. I don't know why it's making me do it this way, but it's not really the end of the world. It's just a little silly to do it like that. But what's cool is as I add each of these, we'll be able to get comparative revenue numbers on all of these and say, okay, comparatively, what do these actually all look like? Yeah. Okay, that's more like it. That's what I wanted to see right there. Okay, great. Great. So check this out. We'll blow this up, make this big, and we will do a comparative to revenue trends. Right? So this is really what we're looking at. Now, what are we, looking at here? Let me explain what this really is. So basically what we're seeing, and this is going to be a little funny, but so we've got all these different series. So what is this, right? Series 1 is going to be this, right? It's Ford. So this is kind of cool. As we go across, we can do, can we name it differently? That's the question. Oh, that's fine. So what we're seeing is, okay, we can see comparatively now what are each of these. So series 1 is Ford, series 2 is KHC, series 3 Verizon, right? Series 4 GM, series 5 is Main, and then series 6 is Home Depot. So we can see, okay, what do these revenues look like? So, we can say, okay, this one obviously a lot lower. Now, there are movements in here. There's harder to see because, right, compared to these huge numbers here, these two are a lot smaller, right? Interesting note. Hey, KHC, a lot smaller revenues. Main Street Cap, a lot smaller revenues, right? That's what we're looking at here. So that's these two lines showing, all right, yeah, they're going to move, but they're a lot smaller revenue levels than we're seeing on these other companies. So, we say, all right, let's say we want higher revenue companies and we want to see the ones that are continually going up. So we've really got two. We got this one, which if we just click on the line, that's all I did. It highlights the GM and then it highlights Ford. And you see, all right, Ford has a little bit higher revenue than GM, but essentially they're moving the same. That kind of makes sense, right? They're premier vehicle manufacturers and sellers. So no real surprise there. And we can see, all right, so Home Depot has kind of flattened out and gone down a little bit. Same story is really true of Verizon. Now, if we look a little bit deeper into these, that makes sense, right? Verizon gone up and come back down a little bit. GM moved, right? Now these are smaller, so they're not really showing, but Home Depot come up and move back down a little bit. So that's kind of cool to see. So what does this tell me, right? This tells me that Ford and GM, right, our two vehicle manufacturers, are showing the highest levels of revenue growth. So, okay, that's interesting. Maybe those two are key ones that we want to really comparatively analyze and decide if we want to move forward with in terms of buying a higher, portion investment or looking into investing more continuing in the long term. So, these are both two that we've kind of looked at that said, hey, these are pretty appealing, right? They have our lowest PEG ratios, right? So what does that mean? That means they're expected to continue to grow, and the price that the market has them at right now is probably pretty reasonable, right? Earnings per share, another key one. Ford, about $1. GM, about $9. So that's a big difference, right? A big difference here. So GM, a lot better earnings per share, but with that higher earnings per share comes a much lower dividend yield, right? Which is really interesting to see. So dividend yield on Ford is pretty appealing. Betas are both over 1, nothing concerning on either of those, right? What else do we want to look at? PE ratio. So price to earnings, right? Ford, we might pay a little bit more for each dollar of earnings than we would on GM. Truth is, though, that's not surprising because GM is showing a lot higher earnings per share than Ford is showing. So what this tells me is, okay, these are both appealing, and I just have to decide what I care about more. Big ones we're looking at, right? Dividend yield. Okay, do I care about 5% versus 1%? Or do I care about earnings per share? Do I want that $9 earnings per share, or do I want that $1 earnings per share? Truthfully, it's debatable, right? It's a good question. So to me, I say, you know what? Those are interesting. Now, this dividend yield to me is probably more important because I really like focusing on cash flow, right? How are my assets that I buy going to turn cash and actually deliver me results, right? And the cool thing about dividends is they actually pay those results. So you have realized gains compared to, as the stock goes up and up and up in value, if you don't sell, then you don't realize gain, which means it's great and it's all theoretical, right? Now it's real money, it's real value, but until you sell, you never realize those losses, so you haven't actually made anything. So for that reason, I like the higher dividend. There's one other thing to consider with these two companies that we haven't talked about. So one is, well, actually there's two things really. One is the technicals, right? So Ford, we can see, okay, Ford is in this kind of longer term downtrend that, it doesn't seem to want to break out of. Now, to me, this is not terribly concerning given that this is, basically 2 years. And it's, gone from really, where did this downtrend, start? It started at the bottom of this drop. So, we can put it right there and it's gone down to where it is today. That's a 7% drop, right? Over the 3 years, and you're getting a 5% annual dividend yield. So your dividend more than covers the drop. So that's good to know. Now there is room for it to continue dropping. And if it does, okay, well, now that becomes a different story. There's also room in this downtrend for it to move up, right? So what that tells me, okay, that tells me this downtrend worth considering, but not huge, right? Not terribly concerning. GM, little bit of a better story on that front, right? It actually was basically in a rolling trend, I would say. Let's see what this looks like. But basically, right, it was rolling, boom, 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 dropped out of that rolling trend and then shot up, right? And this is what we were seeing on the yearly chart is, hey, we moved up really strongly. Now, what's interesting is this looks like it's got some room to drop. Now, it may stop here, right, at this old resistance line where we were dropping off back in here. That might become a new support area around this 50-week level. Truth is, though, right now, we don't really know. So interesting to see. Now, the other consideration that we have with these two stocks. So, and really what that tells me is, okay, GM's technical is probably a little bit better, though it's hard to say just yet, right? We don't actually know what this looks like in terms of future. We're seeing immediate opportunity to the downside. The same is true though of Ford, right? I mean, I've been talking in my daily stock talk. Hey, we've got room to drop down to here, right? So we've got room to drop on both. The other consideration and the final one that I think is important to note is the price, right? The actual dollar price point, right? How many shares can you buy? How, and really to me, this is a question of how fast can you get to 100 shares, right? Because at 100 shares, you can start doing some cool things. And I'm not getting into that yet, but hopefully in the near future, I'm going to put some stuff together on that. But, okay, so this is a $10 stock, basically, right? $10.25 stock versus GM. Okay, $44 stock. That's a big difference. So you could buy 4 shares of Ford for 1 share of GM. That plus the higher dividend yield makes me more interested in Ford, although not by a whole lot, right? I mean, they're both very much appealing stocks. I do think I'm going to lean towards Ford with the lower price, and more importantly, I think that higher dividend yield. Now that EPS, interesting to see. And what's kind of cool is we've still got the 1 share in GM that we can continue to watch and see, okay, how do these actually compare, right? What do these actually end up looking like day by day as we kind of go through? But I think that makes sense. I think that kind of paints the picture. All right, Ford seems to me like probably my favorite investment opportunity. What does that mean, and where do we go from there, right? That's the kind of last question. That's kind of what I want to leave you with is, okay, so we've done all of our analysis. Great. This is super cool. Hopefully you guys have learned some things. Like, I've actually really enjoyed doing this. I haven't done a analysis in depth like this probably for a few months. I did a whole bunch of them in college, right? Did a bunch of them outside of college. I've done a handful, right, for my own personal investments. And, now I just got to do 6 more. So that was pretty cool. And really enlightening, right? It gives you a good picture of what are these companies doing? Are they likely to grow? What are their numbers? How do we compare against each other? Like, this is key, fundamental, basic analysis, right? This is what this stuff is. But the question is, where do we go from there? So, right, I've got my trading plan, and my trading plan calls for 50% of my account to be in investments and 50% to be ready for trades. Now, right now, this is an $803 account. So call it 800, right? I've got $256 available for trading. And right now, all that I'm actually in is these investments, right? With the S&P dropping, the last couple of days, having some uncertainty, not sure where we're going. I've not actually gotten, well, I did get into one trade this week. Got stopped out early and then it hit my profit line. So kind of a funny story. But regardless, right, not in any trades at the moment. So what does that tell me? All right, I've got basically $550 in the in my investments right now, where I should only have about 400 in them. So there's two ways to approach that. One, I could sell some of my investments and say, screw it, let me get back to my trading plan. Or I could be a little bit patient, right? In this trading account, I put in money every 2 weeks. Well, basically, I put in every month. I put in money 2 different times, and what I can do is just wait for my account to grow to a point where I'm ready to invest again, right? So if I've got $550 right now, is about half of my account, right? What does that mean? I need to have $1,100, and then I'll have 550 for trading, 550 for investing. And then from there, as I keep adding more money, and then I can start investing more. So what that tells me is, okay, hey, maybe next time I invest, I take half of the money that I put into my account, right? Half the money I put into my account, on that, twice a month I put in this case, $50. So not a whole lot, right? But it's just an example of how do you actually get started. And I got that because I actually started with just putting in $50 a month when I began looking at doing investing for myself, right? Looking at building my account and kind of going into it, right? I was working part-time in college. Like, I had no money, but I knew that, hey, compounding is a real thing, and starting small helps you grow. So that's what I'm doing in this account. It's kind of fun. But let's say I take $25 and I say, okay, now I'm going to have $25 to put into Ford. Okay, so what does that mean? Really? I could buy 2 shares. Is that a lot? No, it's not a lot, right? It's not a lot at all. But what's cool is that I can buy 2 shares. And then a couple weeks later, at the end of the month, I can buy 2 more shares. And then I can buy 2 more shares. And then 2 more and 2 more. And you see how over the course of months and years, you can grow and grow and grow. So you start with 1 share, then you go to 3 shares, then 5, then 6. And what's cool is then you start getting paid dividends, right? Then you start getting this 15 cent per share dividend. And pretty soon, right, you get up into 80, 90, 100 shares. You go, hey, every time I get paid that dividend, there's another share, right? I can buy another share of stock with that dividend. And so it's really cool. And you can start compounding, and it starts slow, right? Hear me on this. It starts slow, but as you see it growing, oh my gosh, like it's so cool. Because it goes from, hey, I just put in a little bit, like I'm not doing that much. It's just consistent, repeatable investing action over time that really, really allows for compounding. So I think that's kind of the plan, right? Get myself up. So my trading plan is actually right. So I got half my money in investments, half for trading. Um, and then and then from there we can go and start doing kind of consistent investing. So that's the plan. That's kind of how it works. And I mean, I don't know. I hope this is helpful for you guys, right? Let me know if it's helpful because I don't know. These are super cool. I love doing this stuff. It's so exciting, so interesting to me. Now, I mean, granted, all these numbers are a little tedious, and I mean, you guys can hear it, right? It's sometimes you don't know what's best, right? Is that higher dividend yield or is that higher earnings per share better, right? It's hard to say. It really is. And hey, other things like, hey, I could go deeper in Main Street Capital Corporation and find out that's the best one to buy, right? That could be the case. But the truth is, the best one to buy doesn't matter, right? And it doesn't matter if you buy the best stock or the worst stock in the world. Now, I mean, hopefully you won't buy the worst stock in the world. Hopefully, right, you buy a good stock that gives you good returns. But the truth is, like, as you start this investing journey, as you get started in the stock market, it doesn't have to be perfect. It's more important to get started, to figure something out. And then as you go, just continue to learn, continue to grow, right? Let that compounding take place so that, those dividends and that putting money in it helps you buy more shares. And then once you get to 100 shares, you can do other things to turn more cash flow at little to no risk, and sometimes even a guaranteed net positive. Like, there are some really, really cool things you can do. Excited to get into it some more. But yeah, hopefully it's helpful. So that's what I've got for my investment analysis. Hopefully that plan makes sense, and you guys were able to gain some value from it. So we'll be back here on Friday talking about our interesting trade of the week, which may be the one that I got stopped out of and then watched it climb all the way to its profit target level, which, hey, it happens. But also some good learning there. So anyway, we will see you guys here on Friday, and I am looking forward to it. So until then, happy trading and happy investing.